And let's get into this with Neil and Scott.
Well, fantastic. So obviously I've got the English accent, we've got the East Coast accent, and also the West Coast here. So we've got a lot of the market, the relevant bits of the market covered here. I'm going to start with Andrew, and then Scott will introduce himself when I lob him at the first question as well. So Andrew, the theme of this panel, just before the pitches all start, is has what's changed. Now, you started in the 90s. Rather than telling us what's changed since the 90s, just from the peak in 2021, the COVID years, which were really busy for us, no doubt really busy for you. But there are changes now. There's deal size changes, there's deal term changes, there's valuation pressure, there's down rounds, which we didn't see too many of in those days. There's an expansion of the number of venture funds as well, and then a contraction. What are the major changes that you've seen since around 2021 highs?
Well, I'm going to be a good politician and answer a different question. I'm just kidding. But I think you have to say the big change from the 90s, from the late 90s when I was a founder raising venture capital funding, is that if their fund was 50 million, it's now 650 or 550 million fund size. So fund size got bigger. Like back then, NEA was 350 million. Now they're 6.8 billion. Half of that is a CV continuity vehicle to buy out their own LPs from their last fund. So their seed fund is 3.8 billion. So even if they do even if Excel, who's investing out of a 650 here and a 650 in the Valley fund, if they do 500K into Facebook at a 3 million valuation, that sounds like a great investment, but they're putting another like 649 million into growth, where the valuation, if you did a DCF and listed it on a real stock market, would be valued lower than their entry point price. So a big change is the funds have gotten bigger. Whatever your size was, it got way, way bigger. The other change, and I think you probably see this better than anybody in New York, is that it used to be you had to be a very successful entrepreneur to start a VC fund. You know, Mark Andreessen, Joe Lonsdale, Peter Thiel.
Andrew Romans.
Well, I mean, I consider myself, I had an IPO, I had an M&A, I wasn't a total failure before I decided to be a VC. Now, they're all VCs. So I think another big change is that, like New York City, like how many people from New York Angels have tried raising a fund? They were all my LPs, and only a few of them re-up in my new funds. So I'll still go give a talk to New York Angels in New York, but like lawyers are turning VCs. So a big trend is that it isn't just some founders become VCs. It now feels like they're all becoming, VCs, and that's a big change. If I were to try to address your question of what's happened since 2021, I think that, we had peak valuations. So like in 2021, the growth fund who's trying to like flush out and just deploy and move multi-billions of dollars, or at least 1.2 billion in 24 months, ideally. 36 would be we're not doing it right. Which is another change. They would say, all right, what's a comp in the public markets for this SaaS deal? Salesforce, what's that trading at? 12.5x top line revenue. This thing, and they got a lot of growth. This thing's got even more growth. So I think it should be 20x. And then you've got hedge funds, figured out that there's no more bump at the IPO. They're crossing over. So like Tiger Global hires Bain Capital, issuing term sheets to a third of our portfolio, and they never met our CEOs. They never even met him. They just outsourced all that to Bain. And it sounds like a great revenue model, better than even working here. So a big change was that they invested at valuations that just went crazy in the first half of 2021. And that these companies were getting huge, 2x, 4x year-on-year growth. And then they saw, at the rate we're burning, no one's going to, and then 2 weeks later, Putin invades Ukraine, and Salesforce is trading at 5.2x top line, and you're holding the bag having, funded it at 40x, because 20x got inflated with competition from hedge fund crossovers and the big funds. So I think you saw that these companies had to lower their spend and get healthy, and so the growth went away. And this idea that, we're Summit, we invest between 1 and 3 years of an exit. And so even if I give you a low multiple, you get it back and you can compound. You put in 10 million, I give you, 15 million. You put in 15 million, and I give you like 18 million. and after 12 years you're doing well, that's kind of over. So the 2021 financings have to grow into that share price, that went. And nobody likes a secondary to now admit to your LPs in their financial statements that they're down.
So there's a lot there that we'll come back to. The valuation inflection point and the secondaries and the lack of exits then driving behavior. But Scott, just on first introduce yourself and then and the practice from our headquarters, New York, and also some reflections as that Andrew mentioned, for example, the scale of the funds and the proliferation of the number of funds, but that doesn't just mean that all deal sizes get bigger and bigger. You've also got funds doing smaller deals as well, and so the numbers of our practice doesn't do 100 deals a year by only doing billion-dollar deals. So introduce yourself first, and then some reflections from the East Coast.
Yeah, absolutely. So thank you, Neil, and thank you, Andrew, for the whole event here today. As Neil mentioned, I practice out of our New York office, and I co-chair the Global Technology Group alongside Neil. I spend about half my time representing investors from $5 million nano funds up to multi-billion-dollar mega funds and everybody in between, folks that write $25,000 checks and folks that write 100 million plus. We help those folks organize their funds and negotiate with LPs to inbound capital. We've closed anchor LP deals with Apollo, with TPG, BlackRock, that kind of stuff. And then we'll represent the funds on the outbound. So that's about half of what I do. The other half actually is working with entrepreneurs. I know we're mostly focused on the VC and LP ecosystem today, but there's a whole other part of it. And we spend about half our time with those folks, founders from day zero, all the way up through liquidity. And actually most of the time it's at that earlier stage of things when we start to engage with them. Oftentimes in academic and accelerator ecosystems where we work with often first-time founders still in university, places like Harvard Business School where I do office hours 3 times a semester, MIT's Delta V Lab that I've been lecturing in for 10 years, and Columbia Business School for over 15, for example. And we work with founders from those high-velocity ecosystems doing amazing things, but often for the first time and on day zero, helping them build, scale, raise VC, and then exit. So that's a bit of an encapsulation of the practice. As Neil noted, we do a fair number of deals. We've had the privilege in the last couple of months to be quite busy. I closed 3 deals last week, not 10, only 3. But still 3 deals in a week is a pretty good number. We signed a term sheet last Friday on a new deal that we kicked off today. We have another couple of term sheets expected in the coming days. I think I'd say I have about 10 deals active right now. That's a pretty healthy number for a market that admittedly at a macro level is not doing tremendously well as far as deal volume. So as far as what's changed, I think a lot has changed both into and out of that COVID spike that we've seen. Absolutely what Andrew said resonated with me about sort of the rise of the FOMO investor, where anybody in New York City who knew someone with money, which was a lot of people in 2021, all of a sudden was a venture capital investor. And we're chasing these valuations that didn't make a whole lot of sense. And that generally inflated the entire ecosystem. You had both the big players and the small players doing that. And I think we're all experiencing the fallout from that in the present market. Today's market in a lot of ways feels like the best of times and worst of times for a lot of people. For a slice at the very high end of the market, valuations are great, actually. They're way up, believe it or not, from where valuations were. And even in 2021, at the peak, if you look at PitchBook data and Carta data, in the aggregate, valuations in the median Series A now is about $45 million valuation. It's materially up by about 10% above what we saw in the peak market in 2021. At the same time, the aggregate number of deals happening, at least in the United States, is way down by over 50%, something like 60 to 70% reduction in both dollars being invested and deals happening. So we have fewer deals, but higher valuations. And I think the result of what's changed is really an increase in the criteria for what it means to be an investable business, right? And as a result, we have a supply-demand imbalance resulting in this inflated valuations. Go ahead.
I've got a blog post that I dust off whenever there's a stock market correction, and I just update it and post the same thing again. And we're a little bit everyone's like, oh, I'm not going to invest in your fund now that the stock market went down. I'm like, I was praying for the stock market to go down. So this is actually an interesting change in whether it's seed to late stage. When you're in a frothy, crazy market, founders see my list of due diligence questions some that we've developed maybe over the years together. I'm like, was there any founder that's no longer with the company? Let me ask that another way, you liar. Is there anyone who owns 1% or more of the company that's not an investor or with the company? They're like, whoa, you're like painful, Andrew, with all these questions. I don't think you're fit for us. And then the stock market crashes and they're like, hey, you know what? I stayed up late last night, sharpened my pencil, answered all your questions. So it's like founders were kind of lazy, just trying to FOMO their way through these things and not letting a real VC like Jonathan do the work, do his job. So all of a sudden, that's better. Like a real company, I won't say the name, but it's a great company, was trying to raise like 35 million on a 150 million pre. And I told them that's too much money for where you're at. Then they did 7.5 and 32. And it's like, all right, much better. And so like that deal closed in like late September, October of 2021 when we corrected. So all of a sudden the valuations come down, our entry points will be lower, and we'll exit when the economy's back. Like Elon Musk says, it's gonna only last 24 or 18 months. So we'll exit then. We're not day traders that get out tomorrow like crypto. So the fund will perform better when there's a market correction. Anyway, I can go on and on and on, but what are you seeing? I'm curious on like what's changed. What were pre-revenue valuations for the hot deal in New York, in the first half of 2021, and where are we now on a, what do you think is standard terms?
Yeah, those companies are raising at 20, 30 plus with no revenue on a pitch deck effectively. That's come down to normality, and reversion to the mean is effectively 8 to 12 for something like that, raising maybe 1 to 2 million.
Closing the deals.
Yeah, those deals are closing. Those are done on safes, which is another big change from sort of the historical practice. Deals are getting faster because safes are so quick and easy. We close them in 20 minutes sometimes, some multi-million-dollar transactions. And the sort of safe cap would be our corollary for the valuation, and we see that for first fundraise pre-seed and anywhere between, let's say, 6 on the low end and 15 on the.
So just changing the focus a bit, because we're in London and with this audience, but you two are uniquely positioned as both Anglophiles and over here all the time. What's the impression that you Americans have, but doing deals internationally, of the UK market at the moment?
Well, I had dinner and drinks last night with this founder who sold his last company for $8 billion. And then he raised 25 million on his seed round. And 6 months later, another 50. And that's London. And he said he's making everyone come to the office 4 days a week in London. And it's all in London. And he thinks the greatest AI challenge is here. That is not what people are saying in the United States. You got to come here to hear that.
Yeah, exactly. I hear from Americans that AI is US and nowhere else. And
they don't know, like Chamath.
50% of the deals we've closed in the last 12 months are AI deals. AI is obviously pervasive the world over. Scott, from your perspective as well, the international deals that you're doing, those are later stage deals, or are they early stage deals as well?
Just my own client base, for the most part, for the folks that I represent on the investor side that are investing in international deals, those are slightly more mature companies, A, B, and beyond. So that's where we typically see the action for the early stage investors or growth stage that we work with in the US. I find that a lot of really early stage investors have a hesitancy around non-US equities. They just don't know from it. They don't want to hire counsel outside the US. It's too expensive.
QSBS. It's like we have our own version of like you have EAS here, Enterprise Investment Scheme. We have QSBS, Qualified Small Business Stock. So it's like if you invest in a Canadian company, a UK company, you're going to be paying capital gains tax on the gain.
Sure. There are a lot of seed funds that base their entire ROI thesis on not paying any capital gains, and that's not available.
Right. And so if we fund a company, like we funded Saturn in London, which recently, so it's like a couple months ago, and it's like AI for like wealth managers, and it turns into a way for like all of us to raise money even. And we can bring them to the United States. And we know millions of wealth managers from Singapore to the US. So it's like very strategic for us. But the bar is higher to do that. The other problem that we have is that at least I do have a network of VCs. I lived here for 10 years, so I know a lot of VCs. But a problem of investing outside the United States is you have fewer people to take them to. What if the first 50 say no to this deal? No problem. There's another 50. There's another 50. There's another 50. There's another 50. We can even go to New York if we have to. Just kidding. To raise that next round. where there are fewer here.
Absolutely.
Now you could argue that means that the valuation will be lower, but early bird's been saying that their whole life, that everything in Germany is 2/3 off. I don't know if that's true. You get a repeat entrepreneur in Germany, it's going to be expensive.
It strikes me that DPI in Europe and UK.
Define what DPI is, maybe.
Well, you define.
Okay. Well, just because if we all start talking, your high TVPI and low DPI is my arbitrage opportunity, someone in here is like, what? So TVPI is total value to paid in. So you invest in like 20 companies, a few go to zero, and a few have raised money at higher share price that these lawyers are papering, and you mark it up. So your total value to paid in. It's how much of my unrealized gains plus anything that I have distributed. TVPI, total value to paid in. DPI is like all that really matters. That's my distributions to paid in. DPI. So if you don't have DPI on the cover of your pitch deck for your fund, we assume it's not good.
So it'll be interesting to see the pitches.
Oh, they're all top decile. Everybody is.
But we can talk about that. We're talking about things that have changed. DPI is hard to come by these days.
Which we think is a huge opportunity.
Why?
Because if Bob is going to raise his next vintage, and he's actually got a lot of kind of retail LPs in there that are like, people have a spouse, they might follow into 3 funds with very little DPI, but at some point they're going to say, hey, from now on, you want another $500K from us, Microsoft, Amazon people, you got to wire us something and we'll put that right back in it. So we can sit down and say, let's go through the whole portfolio and get you to 1x DPI. Then you go back to all those Microsoft, Amazon geniuses and get them to re-up in the next fund. And in the meantime, our term sheet is like a 30% discount maybe to the last share price, even though the company is growing revenue at 20%.
Sure, but all of that means that fundraising for GPs should be easier, but it isn't. It's more difficult.
Which is like we may change up this format completely to something that works better, but we're thinking, how can we help people raise money?
Yourselves and the market?
Well, so right now, Global VC Demo Day was like saying, let's just do a YC thing, where we're literally investing in these funds. And our motive is not to fleece people for stage time and put anybody on stage, right? But we could talk later over drinks. Maybe we should say, all right, everyone pay like $2,500 and we'll rent out a big vineyard in Napa and have like more content. I'd love to hear Jonathan's actual pitch, but maybe he feels more comfortable just talking about his views of AI versus the internet boom or something. And so we make it a little bit more contenty and we figure out how to get these LPs talking to VCs and get deals done. By the way, on a quick, people like Chamath thinking London is crap and don't even go there unless it's vacation on your way to Italy. Can you disclose what you made on backing Rushma at Seed Camp? What's the multiple you got on that thing?
DPI? Which?
Tell us anything you want. DPI or TVPI. 7x. Seed in London.
When I bought the fund, because then I did a secondary on the fund. And when I did that, there's about 8 to 9x left in TVPI in the fund.
Jesus.
This is about...
Yeah. Which is very interesting because you're getting into a fund just to get in the back door of like the assets you wanted.
That's not what I'm going to talk about today.
Okay, but it's a different thing at Bullhound, but it's very smart.
So,
By the way, Rushma, Jean-Michel Deligny was supposed to be here, had to cancel at the last minute. We're not important enough for him today. But I used to share an office with him at 48 Charles Street here in Mayfair, and Rushma and her colleague founded Seed Camp right next to us. It's funny. Jean-Michel kicked him out for not wearing like cufflinks at one point. They had their knapsacks on the floor.
Andrew, you're not pitching today, but tell us about your strategy.
Yeah, I mean, so maybe what's more relevant with a lot of VCs here is we think that low DPI is a problem. And if you're a mega fund, you probably don't even have room to sell anything in your trophy assets of Revolut or whatever. But if you're a smaller fund, it's important to figure out that DPI. So our thinking at a highest level is invest in this mix of a couple of Sand Hill Road, a bunch of the OG people, we're old enough that we know people for 20 years, and then be in this, maybe 25% of the fund is a wide tail of much smaller checks to many of these funds. If they fail to raise another fund, that's actually quite good for us. We'll take all the pro ratas and all the opportunity to invest in the follow-on rounds of the winners. We're LP in that fund, and we're getting introduced to the CEO saying we're good people. The other thing is to say we will co-invest with these VCs. So even a VC that we don't ever become an LP in, we may ask to be introduced to one of their portfolio companies and be sourcing deals. So over here you've got the fund of funds, and here you're going direct into primaries where the money goes into the treasury of the startup to grow the business, and then other times buying preferred shares from a VC investor, and we maybe buy like 10% up to 50% of their shares in that one company and lock in. And you know what might even happen? You might be up 30x on some deal, sell us 50% of it, and then we might go to zero. Big aircraft carriers are going to get sunk by Chinese subs pretty fast. It can happen. So that's a bit of we invest directly in the startups, buying either primaries or secondaries. And then we think all this activity of bringing VCs together creates a lot of deal flow opportunity. And when you're an LP, you start to you're married with them for quite a few years. You really get to know them. And we think that there'll be some people that are uneducated enough to understand that they should be in a fund of funds, and we can get those people directly into funds of our friends.
And there are a few founders in the room. You're kind enough to let us bring some of our CEO founders along today as well, key ones. What sectors are you also looking in, and are you going to do UK deals again?
Yeah, the bar is higher for the UK. We just did Saturn, so that's a good, that's one example that's strategic. I think we still have it on our website somewhere that if we can't add value, we won't invest. We definitely removed, we're the founders turned VCs, forget that. That's no longer, we used to have that on there, got rid of that. But we want to see 100K, basically like $1 million ARR. I like that 100K point. If you invest in something with more than, there's guys here, and I keep saying Jonathan knows how to make money in those things, but I kind of think, well, if it's got 5 million in revenue and it's priced fairly, that's like a 50 million pre, if you go 10x. And in order to make a 10x return, you've got to get liquid at 500 million. If you raise money from us, our specialty is graduation rate. We're going to introduce you and help you, practice until you get funded. So there's going to be like 5 more funding rounds where they're issuing at least 10% stock in these things. So we've got to literally get liquid at $1 billion to make a crappy little 10x on a company with 5 million revenue that my twin boys born at Chelsea Westminster will not be impressed by, or my wife. I like 30x and 50x. So we kind of find with the direct VC fund, we like that 100K to 500K zone. But during the first half of 2021, when these guys were trying to raise 50 million on crazy pre's, we actually started doing all late stage investing into founders that we knew, where I'm like, we're actually getting a 6x multiple of revenue on that. That makes sense. And maybe it will one day exit and not sink. And we already know everything about that company. So we've been flexible with the changing in the market. But what I like the most is that kind of early stage zone. On sector, I think companies that are automating human workflows, ideally LLM driven, that do the job of thousands of people. And like Zive AI is not here today, but we led their seed round after we became a customer. Like Carta is crazy. Carta wants a percentage of your revenue. Get out of my office with that. Like as I always say to them, thank God I don't pay Dropbox a percentage of my AUM. Where do you get off of that? Or the accountant, So these guys are automating so much that technology built now. Like we were using HC Global Fund Management Services for the K1s and everything. And they have a lot of people in the Philippines that are really doing the work. If they were to do everything that Zive is, does the starting balance of the financial statement match the ending balance of the financial statement? Can you give me a dashboard of what will my IRR be if I double down in this round or if I don't double down? It would just take thousands and thousands of people to do the work that is now just automated, just completely automated. So if we were to pay HC to do the work that Zive does for us, it would be too much of the OpEx. There's just no way we're going to spend that much money on like tax, admin, compliance, and accounting. Yeah. So kind of apply that to every industry. I mean, I don't really love healthcare stuff, but like if you were taking clinical trial data and you pay a bunch of PhD people in Basel, Switzerland, like 350,000 francs a year to create reports out of the data. What if like these reports are being generated in an automatic thing, directly getting information from the clinic, and now you reimagine the workflow, and if it causes hair loss or something's falling off of you, that's being disclosed on the side effects, all right? Like immediately. So it's like programmatic, kind of like smart contract that's going right through it. So I think and like these wealth managers that are using Saturn, it turns like a 1x programmer into a 10x programmer. It keeps you out of trouble with the FCA.
Scott, are those some of the trends you're seeing? And also, in a market where exits are more difficult to come by and there are more and more down rounds, 20% we're told on PitchBook data are down rounds, but actually a lot of down rounds aren't announced, so I think it's closer to 30% down rounds. So without the exits and down rounds as well, what challenges is that bringing for your clients?
Well, what we are seeing, I think, is quite consistent with what Andrew is saying as far as where investors are liking to invest right now is that pre-seed, right? The valuations are much more sane at that level than they were in the past few years. For example, the deals that I referenced earlier, we closed 3 deals last week, too. Every one is the seed transaction, priced seed. And the valuations are anywhere between $16 million post-money and $25 million post-money. Okay, these feel like good numbers. This is not the 40 or 35 that we were seeing for seed or pre-seed in years past. So these numbers have come back down to earth, and the activity is very good there. We're still seeing hesitancy on the LP side to get in at this market, which I think is really like the bid-ask spread that we'd really like to see realigned. I'd love to see more liquidity. I think we all would. That'll unlock a lot of what we're dealing with here. But I think the irony that I was sharing with Andrew earlier when we were chatting is that now's actually a really good time to invest and a good time for LPs to invest into this new vintage of funds. I think we'll see some of the best performance out of this vintage that we have in some time. Certainly dramatically better than the bets they made and lost in 2018, 19, 20. Nevertheless, there's a lot of hesitancy amongst LPs, and it's sort of analogous. I have a variety of clients that invest into either a crypto or crypto-backed or based equities or technology companies built around the crypto ecosystem. And for better or worse, a lot of investors into that ecosystem equate the price of Bitcoin with whether or not it's a good time to invest into that ecosystem. So we went through a cycle where the price of Bitcoin was down. And everyone was calling it crypto winter, and LPs were saying, how can I possibly invest when the price of Bitcoin is so low, the market is terrible, the value is down? Okay, fast forward a year or two, and here we are, and Bitcoin's at over $100,000. And what are investors saying now? How can I possibly invest? The value of Bitcoin is too high. Okay, and so like we see this behavior in all these ecosystems, into VC funds now. I would love to see that break. And hopefully we see some more liquidity to help realign those things.
And in the meantime, are you seeing more aggressive deal terms? Liquidation preferences, participating preferred, 2x, one of my fund clients. You're not, we are. We definitely are. And I'll be very interested to, if anybody wants to interject from the room as well. One of my clients participating preferred, another 2x non-participating, and 1.5x non-participating.
Dividends. I haven't seen dividends in years. It's like a backdoor way of lifting the liquidation pref, right? The
dividends might not be the old 8%, but dividends, yes, there are dividends on my deal.
8% was what I had to take when I was a founder in the 90s, in the early 2000s.
But in those days, we used to flip the company onto NASDAQ in London after 3 years of accounting. But those days are long gone. And so 8% becomes a big number really quickly. And
when there's a correction, the idiom is that after the market correction, where the stock market crashes, is flat is the new up, and down is the new flat. And then you'd see these press releases. I mean, how many press releases of your own portfolio companies goes, it's a testament to this company and their management that we're raising another round at the last share price, the last valuation of the last round 2 years later, even though we doubled revenue. Like that, you see that all the time. The company's doubled revenue. And it's, if the last pre was 20, we're raising again at 20. So it's flat, even though you've doubled revenue.
Now we've got a room full of experts here. So before we come, we're going to ask you to ask questions as well. But are there any comments on what these gents have said so far? Don't be shy. You never have been.
Or maybe I'll see the room with the question. All the deals that I just closed, clean term sheets. Standard 1x non-participating, lick pref, no dividends. You know, valuations are going to vary, but the term sheets were fine. The deal's very, very similar. I haven't seen punitive terms in quite a while, at least in the deals that I've been doing.
What are we seeing here?
1x liquidations pref, and that's it. Yeah. I think New York has, and you know, my family's from there. Spent a lot of time there. It's my number 2 network after the Silicon Valley. But I think there's a lot of very young people investing, either their own money or other people's money. And they need to live through 12 years plus to understand what the outcome is of what they were not negotiating. You know, I'm not saying I'm an evil, rapey VC, but you know, I think the more mature founders, also, you know, you can make it attractive. There's a founder who sold his last company for $1 billion that we're funding in Silicon Valley, agentic, everything. And he put in a 5x liquidation preference, which means nothing for a company that stage. Yeah. It's either going to work or not kind of thing. But I thought it was interesting that he's thrown out, you know, let's put a 5x liquidation preference. Whereas like New York, you'll see, I'm just kind of, you know, digging on New York here, so you can defend, is that they're like, it's a safe with a cap of whatever, 15, and a discount rate of 6. And you're like, do you believe that you're going to have a priced round?
You know what a discount rate is?
That is going to be, do you think you're going to raise a price round below that cap? You're just making yourself look unattractive to some other idiot who's as dumb as you on the investing side.
The trends on more aggressive terms, Brock, I'll come to you in a second. It's very much David from Albion here was just opposite me on a deal and was very gentle with the 1x non-participating. But later stage deals definitely here. We've seen a 2x, 1.5x, and the 1.5x is strategy now for that fund. And these are later stage deals, and also PE coming down into venture. And we've got 5 term sheets on one deal. It's venture, it's minority stakes, it's later stage, and has EBITDA. So you've got a hybrid situation in those sorts of situations with really aggressive PE style terms, with step-in rights and all the rest. Brock.
I just wanted to dial in on what Scott was talking about too. That like we've had 8 companies outraised in this quarter, with 6 raised. Exactly what you said. Totally normal, decent rounds, no problem. And we've had 2, like literally, they're not moving badly, but they're going to hit the wall. And the point I want to make, I was curious if you agreed, is it feels like the penalty you're missing even by a little bit. Like go back to 2021, 22. We had companies that shouldn't have gotten funded, that got funded. They were like, oops, you're kind of missing your mark, but it was kind of a really frothy space. And now it feels like if you're missing, if you're not doing your, like, we invest really early, 10+ a year, and showing that huge potential in front of you, you pay a really high price.
Yeah, and the payment, the high price that you pay is very often one or more of the founders get tapped on the shoulders. And every down round that I've been through goes back to Internet 1.0. Founders get taps on the shoulder. Is that what you've been seeing?
Yeah, I call this effect tale of 2 cities. So if we're in a boom, 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 1999, 2021 market, first half, there's somebody who's suffering and somebody who's winning. And then even after a crash, there's some hottie that everybody wants to fund, and they're immune. So it's a tale of 2 cities. One person's going from strength to strength, and you want to quit your job and do sales for that company. Another one, I always say, would I want to quit my job and do sales at that startup? And there's another one, you're like, oh, this is miserable.
The best of times, it was the worst of times. Questions? Do ask some questions. I'll ask some more then. When we're talking about deal terms, Scott, as I've mentioned liquidation preferences, but what other things have come into the market on your deals, or have they not changed? Is it just valuation adjust, not deal terms?
I mean, it sounds reductive, but that's really what it comes down to, right? It's safes, and all we're negotiating is the cap, and it's price equity, and all we're negotiating for the most part is the size of the plan and the valuation. The rest of the deal largely ends up being what you might expect as a clean term sheet. We went through an exercise over the last 2 weeks where we had multiple term sheets for a company that was raising. They were coming in somewhat different places, big differences on valuation and on the size of the plan. The rest of them were similar, minor differences. We ended up negotiating them all to the same.
What about governance? And this is for both of you guys. Like, you know, talk about a lot in my first book, but like the two sides of a term sheet and, you know, venture transaction is, you know, the economics and then the governance. And so it used to be old school. You got like two founders, the money gets a board seat, the founders get one seat, and there's a mutually agreed to, or the founders get two, the money gets two, and there's a mutually agreed to, odd number. One of the problems I've always had with convertible notes and safes is people just like forget about governance completely, and it's like a crypto with no oversight. No wonder they're going to all end up in prison. You know, if there's no governance. So you basically, no one talks about board seats. These young new VCs.
No. In fact, many VCs that we know and work with don't want board seats.
Yeah, they don't have the attention span. It's like
They don't want to do the work. They don't want the fiduciary obligation. They want to write their safe check. They're going to write, you know, several dozen safe checks out of a fund, and that's going to be their.
So whilst the litigious environment that you're from isn't replicated here at the same sort of level, more VCs take board seats here statistically, as you know, but only at Series A. My clients doing seed, we predominantly don't do seed, but here in the UK, because they're much smaller deals than you have in New York. But some seed with the family offices that I advise, they'll take an observer. But at Series A, this market, my clients are all taking board seats and have always been taking board seats. Now there are aggressive veto rights, and the BVCA new model documents that took 20 years of the worst set of documents you could possibly imagine. But the new set's really good. And there are a couple of things in there that we always change. But other than that, we've now got a set of documents that we can work with. But the veto that I had never seen exercised in my 400 or 500 VC deals is the veto over a £25 million term sheet with VC and followers doing due diligence, and the existing shareholder who didn't follow the money vetoed it. So that veto, I always negotiate here in the UK in this market, but it's a BVCA standard term and everybody talks about that. So some of the governance is the negative control as well as just sitting on the board.
Yeah. I say it in the book that you might think you have control of your board of directors, young entrepreneur, but this guy can block a sale of the company, they can block the funding of the company. And you have a built-in conflict of interest with this person, and maybe you don't even love each other anymore.
But those terms have been, you know, standard for as long as I've been doing this. Occasionally, we'll have brackets around those approval rights where you lose the right to veto the deal if it's over a 5x return or something.
Before we hand it over to the funds to present, in the Valley, it felt like things were getting extremely depressing, like the worst government imaginable. Your favorite restaurant's boarded up. You need like a cop to unlock to buy a toothbrush in a store. It was just getting worse and worse and worse and worse. And then kind of AI has breathed a lot of life into it. So San Francisco's kind of back, I think you could say. People are going out to, you know, the crazy event. People go to 3 events a night and they're all, you know, it's vibrant, I would say. Again, there's still some boarded up stuff. But what's the vibe here? And what would you say the vibe is in New York? You guys have always been much more fintech with Wall Street. You understand that stuff better.
Yeah, so the UK market is frankly really, really difficult for first rounds from professional investors. So there have been new entrants in the market. Just as Scott was talking about the new entrants in New York, there are a lot of new entrants in the market here as well, with small family offices and but some of them higher quality than used to be the case, but new entrants in the market. And so they're still doing seed rounds. EIS is transformative in our landscape up to a certain level, but we've seen, and we're not the market, but we do enough deals to sort of follow the trends, and there are fewer Series A's. But we do late stage deals as well, and obviously those are bigger deals as well. So 50% or more than 50%, our deals in healthcare are AI in healthcare. AI isn't just in America as well, it's here. And the deal that we just closed $80 million in Tel Aviv. And we closed that with US, UK, led from London, three CVCs. Massive trend on late stage deals with CVCs, dumping side letters on you just before completion, saying they want exclusivity and ROFRs and all of these sorts of things which are unacceptable. But that's a massive trend in late stage, as you all know. From the strategics misbehaving, actually, in my view. So there's a lot of time, including some of my own CVCs, none of whom are in the room. Question here.
Yeah, so we anchor first-time fund managers seed stage, and what we're seeing from our side is actually a lot of these early stage businesses are opting to establish VC coming in. They're opting for the variety and they're kind of very niche. And we're also finding that the rounds themselves, the founders are raising less. They're not that inclined to do big rounds. With the use of AI, they can raise less, retain ownership.
Yeah, like a strategy we've had from day one has been, oh, you want to raise 5 million? Let's just do 1.5 now. Let's just do 2.5 now. At a low valuation, your blended valuation will be where you need it. This money will get you the numbers you need to get those big guys in, so there's no risk of you getting there. You know, so convincing a founder to do a smaller round is like non-linear lowering the valuation entry point.
I think there was one more hand. Do go ahead.
Yeah, thank you. As a banker. So, first of all, what similarities and differences do you see between LPs from different generations?
Oh, yeah. I mean, well, if you speak to like Granddad, who took like a recycled can and built $1 billion empire, and you're like, and you could make 3x or 7x if you invest in this fund. He's like, are you kidding? You give me $1 million, I'll give you $1 billion outcome. So the first generation could be very hard, you know, personality-wise to close. They often, that guy or that woman that built a multi-billion-dollar global empire often has a lot of kids to stop the wife from leaving them, or wife 4 from leaving them, or has like all these things. And he's not the greatest dad in the world because he's out there working as a workaholic. Or, you know, drug use and alcohol seems to be worse among entrepreneurs than some other stable jobs. So by the time you get to the next generation, they all hate each other often, and they don't want to take over a business that like has plastic bottles for cosmetics or something really boring, and they're on Twitter, and they hear what we're doing. Ooh, AI, I use ChatGPT, and they're way easier to close than, you know, the actual, you know, wizard who built the fortune. So I think, you know, generational transformation is an opportunity not only for like the Mittelstand PE of Germany, but, you know, you have a higher win-close rate, you know, with these younger generations. So it's interesting to know people like you that have figured out to communicate with them and that they trust you. So VC should all be chasing you at the drinks.
Let's move on to our funds. I'm just going to thank Andrew and Scott for a fabulous panel. Well done, boys.
Thank you. And if anybody wants an introduction to any VC that's speaking or that they met, I'm happy to make that intro. I see like Sean Stetton Rogers is here. There's some amazing people here. Happy to facilitate those introductions.